Good morning and welcome to day 8 of financial accounting for the spring 2022 semester. As always, we'll start with the calendar, looking at what's due, what's coming up, so that you are prepared for that. Happy Valentine's Day, by the way. Happy birthday to my mother. If we look at the calendar, you can see we have 2 items due today. The first one is the Chapter 3 problem. That's the mastery problem. And that should be submitted for grading by the end of the day today to be on track. You know that that's the last assignment that relates to our first exam. So last week we did look at the exam. We talked about the practice set. You know that those are out there and optional to help you prepare for the exam. If you're working on that practice set and you have questions, I will be happy to help you with those. You can schedule time with me through Starfish if you want to do that. If you need a time that's not available in Starfish, just send me an email. I have lots of time available. What's in Starfish is just before and after class, Monday through Thursday, but I certainly can be available, am available in the afternoons, evenings, weekends, whatever you need to get to work around your schedule. We will be starting Chapter 4 today. And as we discussed last week, Chapter 4 is not on this exam. So I would encourage you to consider how you want to time the exam. We talked about that again last week. You are welcome to take the exam at any time. You should have finished all of the assignments for Chapters 1 through and 3. So pre-quiz exercises and problems. So please just make sure Please just make sure that you finish all of those assignments, and then you are welcome to take that exam at any time. And I didn't look this morning. It's possible someone may have already taken it over the weekend, so that, as I suggested last week, you have kind of that clean break between exam 1 and then the material for exam 2. The exam needs to be completed, though, by this coming Sunday, February 20th, before midnight. And the first part of the project that we also talked about again last week, the first part of the project should also be submitted. Now, those are not intended to be done at the same time. And so, feel free to submit that project whenever you are ready. But again, it should be submitted by Sunday. This week we'll be covering Chapter 4. Remember that there is no class next Monday. If you have Tuesday classes, those also will not meet next Tuesday. Those are days off from school. Monday is President's Day, and Tuesday we have Faculty Development Day. Any questions about what's coming up? Anything from Chapters 1, 2, or 3? Those are the chapters on the exam. Anything about how to do the project? Anything else? Just don't forget, please, to, when you go to take the exam, you need to open your ebook before you start the exam. Once you start the exam, it won't let you open the book, I've been told. So please make sure you open the book first. It is intended that you have access to your textbook and any other work product like the exercises, problems, PowerPoints, anything else, your notes you've taken, anything like that, you are welcome and expected to use during the exam. So if you were to accidentally open the exam and then realize you didn't have your book open, please just immediately go into your email, send me an email. What I can do is delete that exam and let you start over again. But if you wait till the next day and say, oh yeah, I forgot to open my book, it's going to be too late for me to help you with that, because you will have already used up your 3-hour time limit. So if you realize that, please send me an email immediately. Even if I can't help you immediately, I'll be able to, because you reached out immediately, I'll be able to help you as soon as I can. Just don't wait. Okay. Everybody good? Any questions? Anything you want to talk about before we start chapter 4, which is, as you know, not on this first exam? All right. So we'll get started with chapter 4 then. Chapter 4 is the accounting cycle. We have 6 learning objectives for this chapter. 5 are showing on the screen right now. Really what we are going to be doing is going through the entire, how does this work? What are the steps in that cycle? If we look at the next slide here, you'll notice on this slide, you can see that there are 2 learning objectives that are labeled app or appendix 1 and appendix 2. We will not be covering those appendices. We have enough to do to cover 14 chapters without covering the stuff that the book already is indicating. This is kind of the extra, the bonus stuff. So you're not responsible for what's in the appendix. Most of the time, you would not see a question on the pre-quiz about the appendices. Unfortunately, I can't control what's on that pre-quiz. So if you do happen to see a question, just do the best you can. No, you only have to get a 60% on that. There definitely won't be more than 40% of the questions from the appendices. So there will definitely not be anything from those appendices on the exercises, on the homework problem, or on the second exam. So we are not going to be covering those at all. Our focus will be on the heart of the chapter, not the appendices. We've actually talked about reversing entries already though, and I actually showed you what one of those would look like when we talked about the accrual of wages, and I said some companies will just automatically reverse that. I showed you in the T accounts on the screen what that would look like if they did have a policy of reversing entries, as many companies do. So, but we are not going to be formally covering that, and you won't be tested on it. So as we keep going then with chapter 4, you'll notice the first appendix, if you read that, it said that the first appendix was about the end of period spreadsheet. So we actually are seeing what that looks like here. We're just not going to be preparing one. So we can actually see that. You're familiar with this flow already that we have throughout the accounting period. The majority of the time of our accounting life, if you will, is spent on just recording transactions as they occur. So if it's a 30-day month, it's 26, 27, 28 days maybe, that all we are doing from a bookkeeping standpoint is entering the transactions as we are running our business, as we are doing whatever it is we do from a day-to-day perspective. And it's at the end of the month, and that usually carries over to the first maybe day or two of the next period when we are finishing up the financial statements from that prior period. So I know you may not be big enough to really see this. Don't worry about it. You don't have to read the numbers or anything. You'll just get the idea. You can see that there are 2 columns. I'm just going to put a line here. Valentine's Day, so I'll use red. So there, to the left of this, there are 2 columns, a debit and a credit column, labeled the unadjusted trial balance. So that's where we are at the end of the period before we do anything to make those adjusting entries that we spent all of chapter 3 discussing. So most of our time goes into just creating what's there. We then look at, well, where are we at the end of the month? What needs to change here? What's in our records that needs to be taken out? What's not in our records that needs to be put in? That's the accrual and deferral stuff that we talked about in chapter 3. And these next 2 columns, between the 2 red lines now, whoops, sorry, that's now crooked. The next 2 columns represent the adjustments. So if we could see closely enough, you would see a match between the debit in one column and the credit for a different account. It's that balance sheet and income statement moving value back and forth that we discussed again all through chapter 3. Then the final two columns, the debit and credit column, is labeled adjusted trial balance. So those are our corrected or adjusted. Those are the ending balances that we're going to use to prepare our financial statements. We now have the good information, the information that has everything in there that we need and nothing in there that shouldn't be in there. So we recognized all of the revenues that we earned that period. We spent some time in chapter 3 talking about how do we know we've earned them in the first place. So we've got all the revenues that we've earned. We are matching against those, all the expenses that helped us to generate those revenues. Our balance sheet accurately reflects our assets, our liabilities, and therefore our equity. And we can go ahead and use those columns from the adjusted trial balance to prepare our financial statements. Now we have discussed, put a line right there. So we have discussed in an earlier chapter, now it looks like I'm trying to write a tic-tac-toe board on the screen, but the accounts above that, remember the accounts are always in a specific order. Assets, liabilities, the permanent equity accounts, dividends, revenues, and expenses. They're always going to be in that order. So where I just put that horizontal line, the accounts above that are the permanent accounts that are going to go to the balance sheet. The accounts below that are the temporary accounts. The ones that are in white are our revenues and expenses. Those are going to go to the income statement. The one that's below the line, but in that yellow kind of color, whatever that is dividends. And the dividends, as you already know, are not part of the income statement. They're not an expense. They didn't help us to generate revenues or make any money. Dividends show up on the statement of stockholders' equity. And then everything above that horizontal line goes to the balance sheet. So everything I'm saying right now should be review for you. We know that the order of preparing these financial statements is income statement, the net income, the bottom line there, net income or net loss, then feeds over to the stockholders' equity statement along with the dividends. And then those ending balances feed into the balance sheet along with all of the other balance sheet accounts, the assets and liabilities. So that should all be reviewed for you. Does anyone have any questions about that? You see how we would use that spreadsheet to see what our adjustments needed to be. We then are putting those adjustments into the journal entries. That was part of what you needed to do for chapter 3 in the mastery problem. It gave you the unadjusted financial statements and the adjusted financial statements. You had to identify the differences and then write those into your journal. And that's what these middle two columns here are for. And then we prepare the financial statements. That's not anything new. We learned in chapter 1 about those 3 financial statements, what's on them, and how to prepare them. In this chapter, we're going to be taking that a little bit further, learning a little bit more about that. When we look at those 3 separate columns, the unadjusted, the adjustments, and then the adjusted trial balance, the bottom of each column, the totals for each column need to match. So the unadjusted trial balance, debits and credits have to be equal. The adjustments columns, debit and credits have to be equal. And then the adjusted trial balance, the debits and credits still need to be equal. That's always going to be the case. I'm just going to skip through this quickly. Remember, if you're going, wait a minute, I didn't get it all down. Remember, you do have these PowerPoints yourself that you can look at any time. They're on the textbook companion website, and you'll find a link to that in the Cengage content area in Blackboard. Okay. So in just a moment, we're going to go to our first exercise. So if you do not already have your chapter 4 exercises open and see now would be the time to do that. We can see here though in in a size that you can probably actually read. The 3 financial statements. So just a reminder, 3-line heading on every financial statement, name of the company, name of the statement, and then the date or range of dates that it covers. We know that all of our financial statements cover a range of dates except the balance sheet, which would only have the specific date. So the balance sheet is like that snapshot. It just shows where are we at this moment. And the other 3 financial statements, income statement, statement of stockholders' equity, statement of cash flows, those 3 show what happened over some period of time. And so it needs to specify the range of dates. So this is for the 2 months ended December 31st, 2023. We already know the basic format for the income statement, revenues minus expenses, to get our bottom line, net income, or unfortunately, sometimes net loss. The statement of stockholders' equity starts with our beginning balances. So you can see for this company, the beginning balances were 0. What does that tell us? The company didn't exist as of November 1st. That's why they're reporting on a 2-month period. That's not a normal accounting period, just 2 months. Normally you would report by the month, then by the quarter, which is of course 3 months, and then for the year. So you wouldn't normally see this for the 2 months, but because it was the end of that calendar year, they were reporting what had happened so far for that company. So that's why the beginning balances are 0. We then show the changes that occurred, and then we have our ending balances. And if you look at these ending balances right here, you'll see those appear when we get to the balance sheet in just a second. This net income that's in blue right here should look familiar because that's the number that came from the income statement right here. So the information flows from one financial statement to the next. That's why you must prepare them in this order. You have to do the income statement first so that you know what the net income is to add to our retained earnings on the statement of stockholders' equity. Now we have these ending balances for our equity accounts. And if I go ahead to the balance sheet, you'll see those balances show up here. So again, we couldn't have prepared the balance sheet until we did the statement of stockholders' equity because we wouldn't know what these ending balances should be. Just a reminder, and we said this in chapter 1, the 4th financial statement that all publicly traded companies are required to prepare and have audited as a part of their annual report package is the statement of cash flows. We don't really talk about that until we get to chapter 13, other than just that constant reminder, hey, it exists, because just like we see information flowing from the income statement to stockholders' equity to the balance sheet, there's actually information from all 3 of those that flows to the cash flow statement. So we really have to understand what's on the first 3 financial statements before we can think about preparing and understanding a cash flow statement. So we'll get to that at the end of the semester. Just want you to keep in mind it's out there. To give you a little preview of the one thing we're going to kind of tweak in this chapter, looking at the balance sheet that's on the screen right now. Again, we already went over the 3-line heading. We know it covers just a single date. It's that picture of where are we at this moment. But what you'll notice is on this balance sheet, for the first time, we don't just list all the assets and then have total assets. We've actually broken the assets into 2 categories. So if I were to show you this, I'll keep using red. So here we have a separate listing, if you will, called current assets. And then starting just below that, we have another category called property, plant, and equipment. Now you'll notice here for liabilities, we actually have a new term there that we haven't seen before. That new term right here is current liabilities. So we didn't just label it liabilities. And we have current assets, and we have property, plant, and equipment. What we are doing here is what's called classifying the accounts. We're just dividing them up. Instead of saying, here's a list of your assets, we divide them up based on what kind of assets are they. So we have these subcategories: current assets, property, plant, and equipment. Other ones that you might see, I'll just put a note here on the screen, even though we don't see them here, we could have additional types of asset categories or subcategories: investments, intangible assets, intangible assets. Sometimes companies might have something called miscellaneous, because they have something that's unique to their form of business that doesn't fit into those other categories. Under liabilities, you can see again that title, current liabilities, and then they have a line that says total liabilities. So that implies that there's some other kind of liabilities beyond current. And you'll see these either called long-term liabilities, or another term for that is just non-current liabilities. And to be consistent, I should probably capitalize that. Okay. So what we're doing, the new tweak that we are doing to the balance sheet in this chapter, is not just listing all of our assets together, but dividing them up based on some other characteristics. So we will talk about that in more in another minute, but I'd like to go to our first exercise at this point. Okay. So you should already have opened your chapter 4 exercises. This is the first exercise. Now, what we're doing in this exercise is not anything new, and we reviewed it a few minutes ago. So I just want to go through these quickly, because we do have time in this chapter to do all the exercises together. So this is one that I would feel comfortable asking you to do on your own, but we can do it together without jeopardizing our time in class. The balances for the accounts that follow appear in the adjusted trial balance columns of the end of period spreadsheet. We just reviewed what's on that spreadsheet. We know there are 3 sets of columns: the unadjusted trial balance, the adjustments, and then the adjusted trial balance. And when we went over that spreadsheet, we said we then use that spreadsheet to prepare our financial statements. And we talked about where those various types of accounts are going to go, which financial statement would include those. So let's start, and rather than going down the list, one account at a time, let's start with the first financial statement that we would prepare, and that would be the income statement. So any accounts that we see that are revenues or expenses, we know are going to go on the income statement. So what do you see on this list of 10 accounts that would go to the income statement? Wages expense, okay, so that's an expense. So that would go on the income statement, absolutely. What else?
Utilities.
Utilities expense would also be an expense on the income statement. Yep. What else? Fees earned. So that would be our revenue account, fees earned. And so that would also go on the income statement. Any others that you see? I don't see any others. So let's go on then to the statement of stockholders' equity. So on the statement of stockholders' equity, we would include all of the equity accounts. As we said in chapter 1, until we get to chapter 12 in April, until we get to chapter 12, we're going to be looking at just 2 equity accounts: common stock and retained earnings. And I don't see either one of those. Those are the permanent equity accounts, but we know that there's one temporary equity account, and that is the dividends. So dividends would go on the statement of stockholders' equity, as would common stock and retained earnings if we had those. And so by process of elimination, we know that everything else that's on this list should be on the balance sheet. But let's just start with our assets first. So accounts receivable, cash, supplies. All of those are assets, so we know they would be on the balance sheet. On the credit side of the balance sheet, we would see liabilities. So that would be accounts payable. Unearned rent is a liability, and wages payable. So those are all balance sheet accounts. You'll notice they did not include common stock and retained earnings, and that's probably because those two accounts go both on the statement of stockholders' equity and on the balance sheet. So that could have created a bit of confusion. And so that's likely why those are not included here. All right. Any questions on that before we keep going? Make this a little bit smaller. Collapse that. Up there. Okay. So in our next exercise, we see one of those end of period spreadsheets that we just reviewed. I'm not going to draw the lines on the screen again, but you can imagine we've got the first set of debit credit columns that are the unadjusted trial balance. We then have the adjustments and then the adjusted trial balance. And it's these adjusted trial balance columns that we would be using those balances. Those are the correct ending balances for our financial statements. It tells us also that during the year, $15,000 of additional common stock was issued. That's relevant because, as you can see here, the common stock row has a $100,000 credit balance at the end of the period before we do the adjustments, and then still has that same balance on the adjusted trial balance. But what it's telling us is, yeah, but it wasn't $100,000 at the beginning of the year. So this information is for the end of the year. But for the statement of stockholders' equity that's going to cover what happened during the year, we will need to know that they also sold some common stock during the year. So if it had a $100,000 balance at the end of the year, and we sold $15,000 during the year, the beginning balance must have been anybody? The end of the year, it had a balance of $100,000. But during the year, we had sold $15,000 more of common stock. So at the beginning of the year, what would that balance be? $85,000. I'm just going to go ahead and put that into our statement of stockholders' equity right now, just so we don't forget. So what we are asked to do then is, in your directions here, prepare an income statement. We know that that's the first thing we have to do, the first financial statement. So we have our 3-line heading already on there. This is for the year. We know we're going to be starting with our revenues and subtracting from that our expenses. So as usual, the software is giving us a bit of guidance about the ordering of those accounts because it only gave us in each drop-down list one option for an expense account. So it's guiding us in the right direction. If we were doing this in reality in accounting software, well, first of all, we just ask it to print it for us. So we wouldn't have to do all of the by hand. But in an actual accounting software, the ordering of the accounts might be based on the account numbers. So it might just print them in account number order. What the software wants us to do is list them from largest dollar amount to smallest dollar amount, except the miscellaneous expense always goes at the bottom. And the reason for that is because that is presumed to be the accumulation of a bunch of different types of miscellaneous expense. So even if it's a little bit bigger than, say, the depreciation expense, it still goes last. So let's start pulling in our balances. Remember, we're using the adjusted trial balance column. So that's the debit and credit column on the far right. We know for our income statement, those, I can get this to line up, whoops. Sorry, I'm just trying to get this to line up. There we go. So we know that those temporary accounts that belong on the income statement are always going to be the last accounts listed on that spreadsheet or in the trial balance. So we start with fees earned, that's our revenue account. Now remember, on our financial statements, income statement, stockholders' equity, balance sheet, and statement of cash flows, we don't show debits and credits. Just because I put this dollar amount in the right hand of the two columns does not mean it's a credit balance. It happens that revenues have a credit balance, but we're going to come down here and put our total expenses in that same column, and expenses don't have a credit balance, they have debit balances. We do not use debits and credits on financial statements. The only reason these are in separate columns is just to make it look pretty. It's just to highlight for us, these are the totals over here on the right and the subtotals here on the left. When you're working on your annual report project using the company that you chose for your project this semester, those financial statements are going to be, I don't recall if I've talked about this before, but those statements are likely to be, I'm going to put two words on the screen here, and I'm putting some spacing between them because the two words are really not related to each other. Many of you will notice on the top of each financial statement, when you review it, it will include in the title, consolidated. Consolidated income statement, consolidated balance sheet. So I wanted to explain what that means. If you see the term consolidated at the top of a financial statement, what it means is it is this totaling or the summing up of multiple, at least two separate companies. And they consolidated them or they just added them together. Why would they do that? Because you've got a parent company and a subsidiary. In order to consolidate those financial statements, that's a requirement whenever your company is at least, well, more than, I should say, 50% owned by another company. So it might be what's called a wholly owned subsidiary, where the parent company owns 100% of the stock in that child or subsidiary company. But it could be that they own 51% of the stock. It's a controlling interest. And the rule is that they need to be consolidated or reported together. So some of you in this class may have chosen a company for your annual report project that I said, you can't do that company because it's not publicly traded on its own. Keenan, I know you were one of those. You chose a company that was a subsidiary of another company that happened to be a subsidiary of another company. And so my response to you when you said, can I do this company? I said, well, you'd have to do this other company because that's the parent. They own the company that you originally asked about and a bunch of other companies. And so the only financial statements we have access to are the ones for the parent company, the ones that are publicly traded independently. So that's what consolidated means. If you see that at the top of your financial statements, it means it's the financial statements of more than one, what we think of as separate companies, but they really may not be independent, separate. For my purposes, the reason I'm bringing this up now, I wanted to talk about comparative. GAAP, generally accepted accounting principles, GAAP requires that companies report a minimum of 2 years worth of data on their financial statements. A minimum of 2 years. Many companies choose to report voluntarily, choose to report more than 2 years. And so as you're working on your project, one of the questions that you have to answer, and you have to answer it actually in a couple different chapters, is how many years of information was included on their income statement, on their balance sheet. And so you know if your inclination is to tell me it was only one, I'm telling you right now that cannot be the correct answer. It cannot be one because of this concept of comparative financial statements. GAAP requires that you disclose more than 1 year, at least 2 years, so that we can compare. How did you do last year? How did you do this year? The reason I brought this up right now then is I was talking about this right-hand column being sort of the totals and the left-hand column being the subtotals or the detailed information. When you look at your company's financial statements, because they're going to have at least 2 years worth of data, what you will see is that each year has its own separate column. They don't do this spreading out like we've done here. The only reason we do this is for presentation purposes, and if we've had more than 1 year of data, this column right here, you know, these individual expenses, we would just report right here underneath the revenues to keep each column separate by year. All right. So things to look for when you are working on your annual report project. Those are things that you will notice. So we can go ahead and type in our data from the adjusted trial balance columns. And as I had suggested might be the case, you'll notice our miscellaneous expense is actually a little bit higher than our depreciation expense. The reason we listed at the end is that miscellaneous is not just one expense, it's a bunch of things that were small enough that they didn't need their own account. Other than that, as I said, the software wants us listing them from highest dollar amount down to the lowest amount. Then we can total those. Grab my calculator. Go ahead and total those expenses. And then because our total revenues are more than our total expenses, we know we're going to have a net income. If our total expenses were greater than the revenues, we would have a net loss. We are always going to subtract the expenses from the revenues. Okay, revenues minus expenses. I'm unsure why, but there is always somebody or a couple people who want to add those expenses to the revenues. That would be a really cool trick. If the more you spent, the more you made. It's not how it works. So please make sure you subtract. I will also suggest that the software, when it doesn't tell us, sometimes it tells us to use negatives in certain situations. When it doesn't say to use a negative or not use a negative, what is almost always the case is you can put in a negative. If you're going to subtract, you can put in a negative. If that helps you to remember, please feel free to put in the negative. I'm going to check that. I don't think I've yet seen one. I'll go ahead and click check my work just so I can see, confirm that yes. So putting in that negative, it still marks it as correct. If that helps you, please feel free to put the negative in there. Any questions about the income statement? Okay, nothing new there. We'll move on then to the statement of stockholders' equity. And our format for the statement of stockholders' equity is always going to be the same. The top line is going to be the beginning balances. The bottom line is going to be the ending balances. So the beginning balances come from our adjusted trial balance. We have our retained earnings of 810,000. We already talked about why we didn't start with the 100,000 for common stock. Because we sold some stock during the year. And then we're going to include a line for each activity, each transaction, each event that affected our balances. So what happened during the year? We issued some common stock, we made some money, and we paid some dividends. For now, until chapter 12. Those are the only three things that we know that can affect our equity accounts. And we talked about those and looked at a couple different exercises in chapter 2 where we use that concept of what can affect our equity accounts. Selling stock, making money, and paying dividends. So we were told that we sold some common stock. You'll notice here it does say to enter the amounts for net loss and or dividends as a negative using a minus sign. It also tells us if it does not require an entry, leave it blank. So I don't need to put in a 0 for net income under common stock or a 0 for dividends under common stock. I can just leave those blank and come down to the bottom and find our ending balance of 100,000. We already knew that was going to be the ending balance because it's what was in the adjusted trial balance. Issuing common stock doesn't affect our retained earnings, but what does affect our retained earnings is this. From the income statement, we made $590,000. We added that to our retained earnings. But then we may also have paid out some dividends. And I need to go up to this adjusted trial balance column right here to see what we paid out as dividends. And we can see that we paid $30,000 in dividends. And because that reduces our retained earnings, we're asked to show that as a negative. It's very helpful to remind us not to add that number. Take our beginning balance, add the net income, subtract our dividends to get the ending balance in retained earnings. And then we just need to add across each row. We could add down that total column or across the bottom row. We should get the same answer. Of course, here we can use the check my work button, but unfortunately on the exam, there's no check my work button. So if it is helpful for you on the exam, you can check yourself by adding down and adding across. You should get the same answer. Any questions up to this point? So we know that these balances from the statement of stockholders' equity are going to roll forward to the balance sheet. And I'm going to just go ahead on the balance sheet, come down here to the equity section. We know, again, until chapter 12, we have only 2 accounts for stockholders' equity. That's the common stock and retained earnings. Remember, the retained earnings balance must come from the statement of stockholders' equity. 1370, 1,370,000. And then our total equity also must match what's on that statement of stockholders' equity. it needs to come from the statement of stockholders' equity. And the reason I'm doing these first and pointing this out to you is otherwise this is what happens, and it happens quite regularly. You're doing your balance sheet, you start at the top here with cash, and you're just copying those numbers over from the balance sheet. Cash, accounts receivable, or to the balance sheet, excuse me, from the trial balance to the balance sheet. You're just copying the numbers, copying the numbers, copying the numbers all the way down here. And you get to retained earnings and you just copy the number because that's what you've done for literally every other item on the balance sheet. But this retained earnings number does not include the new income that was added, and it doesn't include the impact of paying out these dividends. This is the opening balance in retained earnings. We need to use the closing balance. So when you are doing a balance sheet like we're about to do here, if you get to the end and your total assets right here is not equal to your total liabilities and equity, you know that can't be right. And the first thing I want you to check if that happens is to make sure that you use the correct balance in retained earnings. Because 4 times out of 5, that's the problem. If your balance sheet doesn't balance, unless you just made a math error, if your balance sheet doesn't balance, most of the time, it is because you've used the wrong balance for retained earnings. You use the beginning rather than the ending balance. So if you have that issue, first thing I want you to check. So we can go ahead with our balance sheet. I want to point out to you, and I'm going to give you a couple definitions here, that this is what we referred to, or what I refer to as a classified balance sheet. So we don't just list in total all of our assets. We have divided them into these subcategories: current assets, property, plant, and equipment. So I need to define for you what those terms mean. Specifically, what does the term current assets mean? Well, it includes the word asset. So we know already that it's something that we own or control that's going to help us generate revenues in the future. The fact that we tack that word current on there means that this is a subset of the assets. Not all assets are current assets. So how do we know something is a current asset? Well, because it's something that's pretty close to cash. It's something we're going to use up or turn into cash within 1 year, or the normal operating cycle, whichever is longer. So I just threw another term in there I need to keep defining here. So let me put a note on the screen here. So a current asset is an asset that we're going to use up or turn into cash within 1 year, or the normal operating cycle, whichever is longer. So I need to explain what the operating cycle is. And in order to do that, I'm going to draw a couple lines here. Okay. So here's my explanation of what the operating cycle is. If I were to draw a line, right, put a little line there at the end. There we go. This top line from the left-hand edge over to the right-hand edge is how long it is from when we buy our inventory. I can't put it on an angle, but this is from when we buy our inventory. I guess I could just label it here. Buy inventory until we sell the inventory, assuming that we are a merchandising company. We buy the inventory from our suppliers and then we sell it. That red line from buy to sell is, we have a way of calculating that, and it is related to, come on, inventory turnover. So how long does it take us from when we buy the inventory until we sell it? We have a way of calculating that. It's known as inventory turnover. Well, most of the time when we buy inventory from our suppliers, we're probably going to buy it on credit. We'll agree to pay for it later. And so from the time we buy it until we pay our suppliers, is that shorter red line. And we have a way of calculating that. That shorter red line, the calculation for that is payables turnover. How quickly are we paying our suppliers when we buy from them on credit? Now here we have our last line is from the time we sell the inventory until we collect from our customers. So the assumption I've made is that we sell to our customers on credit. If we sell to our customers cash only, we have the cash right here when we sell the inventory. The operating cycle for this company is from here to here. From the time we buy the inventory, then we'll eventually pay our suppliers, we sell the inventory, we collect from our customers. There's an expression from cash from cash to cash. From the time we buy the inventory, pay our suppliers, sell the inventory, collect from our customers. This, and I'm going to put one more arrow on here. From the time we pay our suppliers until we collect from our customers, that time period is known as the financing period, or the cash gap. This upper longer arrow, this is the operating cycle. It's how we run our business. From the time that's everything we do, right? We buy the inventory, we pay our suppliers, we sell the inventory, we collect from our customers. Now we have the cash back and the cycle starts over again. We can buy some more inventory using that cash. We can pay our bills. So to my definition of current assets, it's an asset that we expect to use up or turn into cash within 1 year or the normal operating cycle, whichever is longer. For most companies, the operating cycle is less than 1 year. Oh, and I need to put one more item in here. We have a way of measuring this too, and that is called receivables turnover. Oops. Okay, so the time from the time we sell the inventory to our customers until we collect the cash, collect the payment from them, we can measure that using receivables turnover. In chapter 14, the final chapter that we will cover this semester in May, we will be looking at all of these calculations. How do we calculate inventory, receivables turnover, payables turnover? We will mention them in chapters that are coming up that relate to those. So we have a whole chapter on receivables. We'll talk again about receivables turnover and what does that mean and how do we use it. But at this point, the only thing that you need to really be aware of is this concept of operating cycle. How long is the typical cycle of our business? So if you think of a grocery store, their operating cycle is generally less than a month. It might be just a couple weeks. They buy the inventory, they sell it pretty quickly, especially the things like, highly perishable things like dairy and bread and produce, right? You're going to sell those pretty quickly. Most grocery stores aren't selling on credit. And so this receivables turnover is negligible. It's very small if it's anything other than zero. Their operating cycle is going to be very quick, a couple weeks, to less than a month. A department store like Kohl's or J.C. Penney, their operating cycle is about 3 months. So you think about there's turning over merchandise seasonally, right? So you got fall, spring, summer, winter, and they're turning over their merchandise roughly every 3 months. How you run your business or what type of business you are really dictates what your operating cycle would be. You think about car dealerships, you know, they have an operating cycle that's closer to a year because that's when new models come out, right? Just once a year. The majority of companies, their operating cycle is less than a year. I think you probably can see that from those examples I just gave you. The majority of companies, the operating cycle is less than 1 year. So our description of what a current asset is, we said it's something that's going to be used up or turned into cash within 1 year, or the normal operating cycle, whichever is longer. For most companies, the vast majority of companies, their current assets are things that are going to be used up in the year. So when we think about current assets, before I go back to our exercise here, does anyone have any questions about what I explained here on the screen? Operating cycle. The financing period is from the time we pay our suppliers until we get the money back from our customers. The operating cycle is from when we start the whole process by buying the inventory. Now, if we only did a cash business, if we paid our suppliers in cash and we sold to our customers in cash, the operating cycle and the financing period would be exactly the same. It'd be from here when we buy the inventory to here when we sell it. But most businesses are not just strictly cash businesses. Any questions about that? Okay. So I'm going to scroll up here back to our adjusted trial balance. Is it okay if I erase what's on the screen? Is everybody okay with that? So we know that on our adjusted trial balance, the part that you can see right now, there, the parts that you can see right now are the permanent accounts. These are the accounts that go on the balance sheet down to, but not including dividends. If I can get that off the screen, here we go. So all of the accounts you can see right now are the accounts that are going to go onto the balance sheet. But we know that the common stock and retained earnings, in particular retained earnings, the balance isn't going to come from here. We already entered those to remind us they have to come from the statement of stockholders' equity. The accounts, though, we know from earlier chapters, these, if I just highlight down to there, those are the assets. Those are the accounts that belong in the asset section of the balance sheet. And we learned in chapter 1 that the assets appear in a specific order from most to least liquid. Liquidity refers to how close something is to cash or to being used up. So we already know, looking at this information, that the accounts at the top, I'm going to put a line right through there, the accounts at the top of that list are going to be the current assets, the ones that are going to be used up more quickly. And then the accounts underneath that are going to be, knowing the two categories we're going to be using, the accounts now between those two red lines are going to be the property, plant, and equipment accounts. Those are the accounts that appear at the bottom of the list of assets. Those are the ones that we're going to have around for the longest time. We're not going to use those up within 1 year. So we go back to our balance sheet. We know we're going to be entering cash, accounts receivable, and supplies as current assets. And just bringing in those balances. Oops. And I happen to have my 234, happen to have mine printed out here, so I'm just, rather than scrolling up and down and making people seasick, I'm just going to look on my printed out paper. Make sure you're pulling the balance from the adjusted trial balance section. Now, you know, for cash, it's going to be exactly the same because we don't adjust cash, but we did adjust both, we did adjust our supplies account. So make sure you're pulling that ending balance. And then we have a subtotal. Total current assets. Under property, plant, and equipment, we had land. And then we had office equipment. And we learned in one of our final exercises from chapter 3, we spent quite a bit of time talking about depreciation, depreciation expense, and accumulated depreciation. We know that that accumulated depreciation is a contra asset account. It goes against the asset. What I don't believe I mentioned in chapter 3 is that all of our physical assets that are used in the normal course of operation, such as equipment, buildings, vehicles, machinery, all of that is subject to depreciation. But there is one long-lived asset like that that is not subject to depreciation, and that is land. So we'll talk about this more in chapter 9, which is the long-term assets chapter. But land isn't subject to depreciation. When we acquire land, we put it on our balance sheet at that historical cost at what we paid for it. And we just leave it alone. Okay. We just leave it alone. We'll talk more about that in chapter 9. The office equipment, though, as we learned in chapter 3, is subject to depreciation. And so what we show is both the original or historical cost, $400,000, and the part of that we have used up or recorded as expense. I am showing that as a negative number to remind you that we need to subtract. Remember from chapter 3, accumulated depreciation has a normal credit balance. It's called a contra asset because it goes against the asset. It reduces the carrying value of that asset. And in chapter 3, I told you that book value and carrying value mean the same thing. It's what the asset is worth on our accounting records. It is not, probably not even related to how much it's worth in the real world or the fair market value. If we were to sell that equipment today, it might be worth $328,000. It might be worth more or less than that. The part that gets added into our total assets, though, is that book or carrying value, the $328,000. So when we total up our property, plant, and equipment, we're using the book or the carrying value. But there is no such concept for the land because land does not get depreciated. Now we have our total for property, plant, and equipment. We can add that to our current assets to get our total assets. And before we go to the other side, the credit side of the balance sheet, I want to talk about this for just another moment. So what was wrong with the way we've been doing the balance sheet since chapter 1? Why did we have to throw in this classification idea of having separate subcategories like current assets, property, plant, and equipment? And I gave you a couple other categories that you might see, such as investments, intangible assets, miscellaneous or special assets. Why do we bother to do that? It all goes back to chapter 1. We talked about why we do accounting in the first place. So the whole purpose of accounting is to help decision makers make decisions about our company. And we want to give them the information in as useful a format as possible to help them make those decisions. One of the decisions that they might be making about our company relates to, gee, if we lend money to them, are they going to be able to pay us back? And so dividing up our assets and also our liabilities based on when they're going to be used up or turned into cash, or for the liability side, when they're due, is going to help us to do some of that comparison for decision-making purposes. I'll mention this again on Wednesday when we get to the last part of the chapter. But it is helpful for us to be able to compare our current assets. So what do we have this year? It's going to be used up or turned into cash this year. We might want to compare that to our current liabilities. And in order to see why, let me give you a definition of current liabilities. So we already know their liabilities, the word's right in there, something we owe to someone outside the company. The fact that they're current means that they are due within 1 year. And in addition to that, we are going to use current assets to take care of those current liabilities, to pay them off, to relieve them. So it's really helpful for us to know in our liabilities, of these liabilities, how much is due this year, and then we can compare it to our current assets. This is what we have available to pay for them, to take care of those liabilities. Could someone who was handed a balance sheet that was not classified, could they make that same kind of a judgment? Probably, but there might be some guesswork on their part, looking at the liabilities. Okay, which of these liabilities are due this year? Looking at the current assets, or looking at the assets in total, which of these are available to use this year? So it's just helpful for decision makers if we have already done that legwork for them, to provide them the information in that type of format. And again, when you look at the company that you've chosen for your project, you will see that they have their assets and liabilities classified, already divided up based on that subcategory. Are they current? Are they investments? Are they property, plant, and equipment? Or are they intangible assets or something else? For this particular company, and go back up to the trial balance for a moment. For this particular company, we can see that they have just two liabilities listed here, accounts payable and salaries payable. Both of those are going to be current liabilities, right? Our suppliers are not likely to wait more than 1 year for us to pay what we owe. And our employees are not likely to want to wait more than 1 year for us to pay them what we owe them, what they've earned for their salary. So both accounts payable and salaries payable are going to be current liabilities. Because we have two, we are going to list them and then total them. If we had just one, we would not have a separate line that says total liabilities. That's redundant. It's not necessary. But because we do have two, we are going to list each one separately and then have a total liabilities line. If there were only accounts payable, the 41,500 would simply be out here in this right-hand column as if it were the total. And then we can add those two together, our total liabilities. And it better be that that total liabilities and equity matches our total assets. It does. But as I said a few minutes ago when we started this exercise, if it did not, the first thing you should check is, did you use the ending balance for retained earnings from the statement of stockholders' equity? So this company happens to only have current liabilities. As I mentioned, most companies also have long-term or non-current liabilities. So those would be things that aren't due this year, or if they are due this year, we're not using current assets to pay for them. Okay. And get all of our green check marks in there. So any questions at this point? Any questions? Okay, let's keep going then. This exercise, our next exercise, is going to give us an example of what the statement of stockholders' equity would look like if the company had a net loss. So how do I even know that they had a net loss? Well, I know because it says it right here, net loss in the title. But there's another way I can tell. When I look here in the retained earnings account, you can see that we have, can't highlight only those. We can see that we have two debits to the retained earnings account, one and both at the end of the period, at the end of April. One is for $31,200, the other is for $5,000. Well, when I look at the dividends account, I can see the credit side of that entry was to dividends. The $5,000, let me just get my, there we go. So the 5,000 here and here match up, right? The debit and the credit. I know the 5,000 then was for the dividends. But what was the 31,200? That would be for the amount that came from the from the income statement. If we made money, if we make money, it adds to retained earnings, right? It would be a credit to retained earnings. The fact that that's a debit tells me that we must have lost money. So on our statement of stockholders' equity, you can see again that 3-line heading, name of the company, name of the financial statement, and the range of dates that it covers. We know that the stockholders' equity statement, the top line is always the beginning balances for, in this case, the year. The bottom line will be the ending balances. Those beginning balances are given to us. We can see those in the T accounts labeled May 1st, 2014, or whatever you want to call that. 10,000 in common stock, 475.5 in retained earnings. We already know the only items for now, the only items that can affect these accounts would be issuing new stock. We look at the common stock account, we can see that right here on July 1st, there was a credit for $7,500. We increased our common stock by $7,500. And the only way that could have happened is by issuing more stock. At least the only way it can happen for now. Certainly the most common. We already talked about this $31,200 debit to retained earnings representing a net loss. That reduces our retained earnings, so I'm showing it as a negative. Remind us to subtract. And then the third item is dividends, and we saw that there were $5,000 worth of dividends. Again, because those reduce our equity, reduce our retained earnings, I'm going to show those as a negative. And then we just need to add across and add down. And then we have our ending balances, and those are the balances that would carry forward, roll over to the balance sheet for those two accounts. Okay, so that's the only difference that the only new information there is what does it look like when we have a net loss? It's going to be shown as a negative and reduce our retained earnings. Where net income would be a credit to retained earnings would increase our retained earnings. Any questions so far? Let me skip over here to go back to our PowerPoint and talk a little bit more about what we're going to do next. So the concept of what we're going to do next is not something new. It'll be the first time we've done the accounting piece of it in these upcoming exercises, but it's not the first time you've heard about it because I have mentioned it, I've talked about it in the last chapter. And I've used the terms permanent or real accounts for the balance sheet accounts and temporary or nominal accounts when I refer to the income statement accounts and dividends. So those terms are not new to you either. What we're going to be doing then in the next couple exercises is seeing how we put this into practice. So we know that the temporary or nominal accounts get zeroed out or closed at the end of each accounting period. And we've seen in the statement of stockholders' equity what happens to those temporary or nominal accounts. The revenues and expenses combined give us our net income or net loss, and we add or subtract that from retained earnings. We add it to or subtract it from retained earnings. Our dividends get subtracted from retained earnings. In the last exercise, we saw that in the T accounts. On the statement of retained earnings, we've now seen it a couple times where we add or subtract those numbers, those amounts, to our retained earnings to find the ending balance. So what we're going to be doing in the next couple exercises, it'll carry us to the end of class today, is thinking about and seeing, talking about how that happens in our accounting records. We can see how it happens in the financial statements, but how do we get it in our accounting records so that those amounts in those accounts actually go away or get closed or zeroed out? And I gave you a little bit of a heads up about that last class when we talked about the accrual for wages payable. And I showed you the reversing entry, and I talked about how the wages expense gets zeroed out or closed and the wages payable stays there and carries forward to the next period. We are now going to see what that looks like. So the title of this chapter, as we started class today, the title of this chapter is the accounting cycle. And as I said, through most of that period, most of the month for most companies, for most of the month, we are just recording our transactions as they occur. And then at the end of the month, we're going through this adjusting process that we learned in chapter 3, and then the closing process. So after we've done all the adjustments, we can prepare our financial statements. We just did that. Then we have to prepare the closing entries to close the books and prepare for the next month, the next accounting period. After the closing entries are posted, and we saw what posting means as we move the impact of those transactions from the journal into the ledger. After we've posted all of our closing entries, all of the temporary or nominal accounts must have zero balances. And so we then prepare, I'm just going to go ahead here, hang on a second. There, this is what I was looking for. So once we prepare the closing entries and we post them, we would print one final trial balance for the period. And as you can see on the screen right now, it's called the post-closing trial balance. And if you look carefully at what's on here, if we even just look at the account numbers start with 1s, 2s, and 3s. We have our assets, we have our liabilities, And we have our equity accounts, the permanent equity accounts. Retained earnings is the last one because the dividends, revenues, and expenses have all been zeroed out. And they don't show up on the trial balance unless they have something other than zero in there. They have to have a non-zero balance to show up on the trial balance. And so you can see here on the post-closing trial balance, it's much shorter than any other trial balance. So if I was to go back, give me just a moment here. Where is it? If I were to go back to the very beginning of where we started class today, and if I can just get you to focus in on this end of period spreadsheet, same company, the unadjusted trial balance has a bunch of accounts that appear after the common stock and retained earnings, dividends, revenues, and all these expenses. The adjustment column even added more to that. So you can see here, insurance expense, depreciation expense didn't have anything in them before the adjustments. So those accounts would not have appeared on the unadjusted trial balance, but would appear on the adjusted trial balance. So the adjusted trial balance has more accounts listed on it. It's longer. The report is longer than any other trial balance. And scrolling ahead here. Hopefully I'm not thinking anyone crazy. Here it is. Going back to our post-closing trial balance, this has fewer accounts on it than any other trial balance because it doesn't include any of those temporary accounts. The dividends, revenues, and expenses have been closed, zeroed out. They don't appear on here. We would always want to prepare this post-closing trial balance to make sure that that is the case, to make sure our report ends after the permanent accounts. We have only the balance sheet accounts showing up on there. And then we're ready to start the month of January because this report's from the end of December. We're then ready to start the next month with a clean slate. The permanent or real accounts carry their balances forward. Certainly, if we had $2,065 in cash at the end of December, we would expect to have that same amount at the beginning of January. If we had $250 worth of wages that we owed to our employees at the end of December, we still owe it to them at the beginning of January until we actually pay them, right? So all of these accounts carry their balance forward, but those temporary or nominal accounts do not. And so what we're going to be doing in the next exercise is talking about how we, actually we have one more exercise to do. Then we're going to talk about how do we actually accomplish this closing process? How do we actually get those accounts so that they're at zero? So let's go back to our exercises. Because I had skipped over exercise 4 for some reason. And then I just saw it here on my printout. So let's go through exercise 4, then we'll talk about exercise 5. Identify each of the as a current asset or property, plant, and equipment. So I think you could probably do this without any kind of discussion because we've really talked about this, but remember, you can hover over the green writing to get a definition. We already know that current assets are assets that we're going to use up or turn into cash within 1 year or the normal operating cycle. So that's going to include current accounts receivable, cash, prepaid insurance. We probably haven't paid for more than 1 year of insurance in advance, supplies. Property, plant, and equipment are those physical, tangible assets that we're going to be using in our business in the normal course of operations and use them for more than 1 year. These are the assets that are subject to depreciation with the exception of land that we already discussed. So I apologize. I don't know why I had skipped over that exercise when I was going forward. Any questions about that though? I don't want to rush it if you do have questions. So now we'll move on to the exercise I actually thought we were on. Identifying accounts to be closed. So to recap, balance sheet accounts are permanent accounts, they don't get closed. Everything else gets closed, dividends, revenues, and expenses. So for each one of these accounts, as we learned in chapter 1, for each one of these accounts, when you see an account title, the first thing you should be asking yourself is that, what type of account is it? Asset, liability, equity, dividend, revenue, expense. Those are the choices. So accounts payable is a liability. It's a balance sheet account, does not get closed. Accumulated depreciation. It's a contra asset. It's a balance sheet account, does not get closed. But how about depreciation expense? Yeah, it's an expense. It gets closed. Equipment? No. Property, plant, and equipment does not get closed. Common stock, stockholders' equity, does not get closed. How about dividends? Dividends is a temporary account. It gets closed. Fees earned is a revenue account. It gets closed. Land, property, plant, and equipment does not get closed. Supplies is a current asset. Does not get closed. The next two, though, are expense accounts. And yes, they definitely get closed. And finally, wages payable is a liability. Current liability does not get closed. So at this point, you should have a sense of how to identify what type of account it is and know which type of accounts will get closed, dividends, revenues, and expenses, which types will not, the ones that are on the balance sheet, assets, liabilities, and the permanent equity accounts. Let's go ahead then. And this will be our last exercise for today. Exercise 6, closing entries with net income. Automation Services Company offers its services to companies desiring to use technology to improve their operations. After the accounts have been adjusted at December 31st, which is the end of their fiscal year, the following balances were taken from the ledger of Automation Services. So the types of accounts we have here: revenues, dividends, expense, retained earnings, and some more expense accounts. And what we are asked to do is journalize the closing entries. So you can see that there are two separate closing entries there. I will tell you that there are a couple different ways of doing these closing entries. This textbook asks you to do it. I'm going to go back. Give me 1 second here. Okay. This textbook has us use a two-step process. The first, so we have just two entries. Some textbooks, some companies use a four-step process. I'm going to explain the two different processes, but we're going to be using the simpler one. The two-step process makes it a little easier. I'm just going to talk about the four-step process first. The four-step process, the first step is to close the revenue accounts, and they close them to a separate account called the income summary. Then you close the expense accounts to that same income summary account. Then you close the income summary account, you move the income or loss to retained earnings. Then you close the dividends. So the fourth step is closing dividends. That's the second step here, and that step would be exactly the same. What this textbook does differently than what some textbooks and some companies choose to do is they combine the whole income step into one. So instead of having 3 steps, revenue, expenses, and then income, they do the whole thing at once. And it is more efficient that way. I have no issue with that. I just want you to be aware, as you've heard me say before, that not all companies do things exactly the same. And so the way we do it here for this textbook is a little bit different than some companies may choose to use. So we're going to go through the 2 steps. So looking at these accounts, the first step is to calculate income or loss and move that to retained earnings. So of the accounts that are listed here, which ones are we not going to close in this first step? And I'm just going to put a line through the ones that we're not going to be looking at right now. Dividends is not going to be part of this first step. And retained earnings is a permanent account. It doesn't get closed. Okay. All of those other accounts, the revenues and the expenses, are going to be closed. Now you'll notice it doesn't tell us whether these accounts have a debit or credit balance. We will assume that they have their normal balance. So the normal balance for the revenue account is what? Debit or credit?
Credit.
Thank you. The normal balance for a revenue account is a credit balance. So we have fees earned with a credit balance of $614,500. How are we going to bring that down to zero? What do we need to do to that account to make it, to bring that balance down to zero or to close it? If it has a credit balance in there, what do we need to do?
Debit that account.
Thank you. So we need to debit that account for the same amount that's in there on the credit side, right? If there was $5 in there, we would need to take $5 out. In this case, there are $614,500 in there. We need to take out $614,500. That will zero out or close that account. The expense accounts then all have normal debit balances. To close those, then we would need to credit them. So we have rent expense. I'm going to credit that for 140,000. It had a 140,000 debit balance. I just wiped that out, brought it down to zero. We go through each one of those: supplies, wages. Wages is going to be on the next line. Okay. Because somebody may be wondering, especially because they just forced me to put the wages expense on that bottom line rather than the order they were in the listing up above. There is no incorrect order for those expenses. There's no one correct or incorrect order. Doesn't matter what order they're in. What matters is that the credited accounts are listed after the debited accounts. And so the reason I skipped this line is because I knew what was going to happen next. But the way we would know that is by calculating, did this company make money or lose money? So to find that out, we have to add up all of the expenses. 140,000 for rent, plus 18,200 for supplies, 320,000 in wages, and 8,700 for miscellaneous. Our total expenses then are $486,900. That was less than the revenues, and so we know that they're going to have a net income. In order to balance this entry then, right now the credits are lower, 486,900. The credits are lower than the debits. Give me 1 second here. Find out how much lower I have to subtract. I need a debit of $127,600 to make it so that the debits and credits are equal, as we know they must be. That represents the income, right? Revenues minus expenses is our income. We had a positive or a net income, not a net loss. We know that because the revenues were greater than the expenses. When we have income, we add it to retained earnings. If it was a loss, we would subtract it or debit retained earnings. So I knew I needed to credit retained earnings for the income. Now, all of those accounts, other than retained earnings, all of those accounts, the revenues and expenses have been zeroed out or closed and they're ready to move on. As we run out of time here, I want to make sure we finish up this exercise. Step 2 of the closing process is to close the dividends. Dividends, like an expense account, has a normal debit balance. So to close dividends, we need to credit the dividends. And just like we saw on the statement of stockholders' equity, those dividends get subtracted from retained earnings. We debit retained earnings for those dividends. So that is the closing process. All of the accounts, dividends, revenues, and expenses all need to get zeroed out. How do we zero out? Whatever's in there, we have to enter that amount on the opposite side. If it has a credit balance, we need to debit that same amount. If it has a debit balance, we need to credit that same amount. The income or loss gets moved to retained earnings in step 1. The dividends get moved to retained earnings. Okay, they want me to change the order of those. That's, as you know, that's really unusual that it gives you the option of doing these in the wrong order. After I just finished telling you there is no wrong order, there actually isn't a wrong order, but there is an order that the software expects you to put them. There isn't actually a wrong order, but there is an order that apparently the software will flag as being incorrect. Normally, it won't allow you to put them in the wrong order. Okay. So you'll notice, I'm now noticing, as we finish up here, we're out of time, but you'll notice that it actually had us put the expense accounts in dollar order. That's not correct, or I mean, it's fine. It's not the only way of doing it. Having these accounts in any other order would have been perfectly fine. It accomplishes exactly the same thing. All right, so we're out of time for today. That's where we will stop. On Wednesday, we will pick up with exercise 7. In the meantime, if you're preparing for the exam, you're working on that practice set. If you get stuck, you want help, please just let me know. I will be glad to help you with that. Any questions before I stop the recording? All right, thank you all for being here, and I'll see you on Wednesday.